Good evening, ladies and gentlemen, and welcome to our webinar on the effects or the October effect on the global markets and stock trading. Tonight's class is brought to us by one of the world's leading platform providers and one of the most unique platform providers out there called TradeTime, where you can define, customize, and trade at your convenience. The unique thing about TradeTime is they allow you to customize and personalize your entire trading experience. So let me pop on a video here and share it with you, and then we'll go on to our class tonight. But TradeTime is one of the most popular sites out there because of their unique features. Uh-oh. I don't know what. Okay, I guess the video is not coming up, so we'll go on to something else. Okay, they offer account customization, trading tools, fund securities, and a robust platform. They have a very unique technical analysis and market information section. Okay, again, I don't know what's going on. There we go. Sorry about that. They have a very unique technical analysis and market information system where you'll see all the update information on the markets. You get advanced charts, you'll see market trends, and you get constant analysis and updated news right on your site. They have a very unique, easy-to-use platform that's intuitive. They offer advanced charts and indicators and one-click trading. They also have their unique live signal trends that'll pop up right on your screen, and you can see here in this example, the Swissy, what their trend is advising you to do. You'll tell you what the first objective, the second objective, and where you should be placing your stop loss, tell you how many traders are using that signal at the moment, and you can actually initiate a trade by simply clicking on the Seize the Moment button and just type in how much you want to invest, and you'll have that trade locked in very, very quickly. So remember, when you trade with TradeTime, everything will be customized by you, and you don't have to open an account. When you go to their website at www.tradetime.com, it'll ask you to start customizing and describing exactly what you're looking for, what experience you want, what levels you're at, before you even enter any other personal information. And they're going to be starting to calculate and put together the right type of account for you. It is like trading on the next generation platform with a very unique platform provider. So tonight in our class, we're going to talk about things you should know for the October effect on the markets. Now, tonight's class is being recorded, and all the classes we offer you can find by going to investing.com, go under webinars, and then click on webinars on demand, and you'll see all of our webinars that we've offered on the platform, and you can watch them at your convenience. Now, October is a month of falling leaves and ghoulish costumes. If you're a U.S. citizen or you live in the States, you know it's Halloween season, the time of ghosts and costumes and partying and trick-or-treating. And around the world it's caught on a little bit, so it depends on where you live and how much you're familiar with the Halloween traditions. But this is also a major market month. But it's also known as a month of falling stock prices and terrifying investment returns. Now, that's hard to say when we see the U.S. stock exchanges trading at record highs, breaking 23,000 for the first time in history. So, do we actually have an October effect going on? Now, perhaps so, if you believe in something that's called the October effect. Some investors are known to get skittish this time of year because many of the worst stock market crashes have actually taken place in the month of October. But is this nothing more than a coincidence, or is there something we should be looking at in the month of October? Now, the October effect refers to the notion that bad things happen to the stock market in October. Now, as far back as 1929, when we had the Great Depression, It was preceded by several historical bad days in the market, all taking place in October. The Black Monday crash of 1987, in which the market dropped 22%, I remember that day well, took place on October the 19th. Then on October the 9th, 2002, the market hit a 5-year low point, and the market dropped 16% in October of 2008, the start of the Great Recession. Do you remember that? The day that financial markets kicked off? Went crazy. You know, with Lehman Brothers tanking, the whole world went upside down. All of us can remember that. We're just coming out of that financial crisis. So now there's no evidence that these big market crashes that took place in October for any reason other than it was coincidence. There may be enough investors who believe in it to cause a sell-off. Because remember, trading is really about the psychology of the traders. So if traders get worrisome about things, it could just cause a psychological effect. It's no different than when you're looking at points of support or resistance, where you're talking about gold hitting $1,300 or $1,400. It has a hard time when it gets to that because all the markets respond to those prices, and all the traders are getting ready to react to those prices. According to a new report, the average monthly return in October is 0.4%. That's not a massive return, but there were 51 years of positive returns versus 36 years with down markets. It's worth noting that when the market goes down in October, it does go down hard, to the tune of 4.7%. So even though we've had historically big crashes in the month of October, overall, October's been a positive month. The fact is, when it does crash, it's bad. But there are offsets by good months that average a 4.1% gain. In other words, history shows that October could swing big either way. And this month, or this October, it looks like it may swing the positive way. But we're just halfway through the month, with the U.S. market starting earnings season, and earnings seem to be continuing to push the market upward. But will it top out at 2,300 and take a big crash? Will something crazy happen? Will Donald Trump push the button on North Korea? Now, October's next door neighbor, September, is actually statistically the worst month for investors. September has had 47 down months compared to 39 up months since 1928. On average, investors lose 1% in September. So maybe the best thing is to do is sell in August, be out of the markets in September, enter back in November, and ride it out through the first of the year. But there is actually a way to do this and predict when you should be entering and exiting. Now, the stock market is hard to predict, but there's one thing that has been reliably true, and that's the fact that the market goes up over time. If you have a long investment horizon, you shouldn't get caught up in worrying about the performance of a single month. You know, stocks historically, for as long back as we can go, have continued to rise. And if you're just putting them in your investment portfolio, what do you care if 1 month is up and 1 month is down? But most of us here tonight in class are speculators, not long-term investors. So yes, if you're putting it away in your retirement portfolio, or you're buying stock for steady growth income, sure, don't worry about a month. But if you're trading stocks, or you're looking for short-term profits or big jumps, you should be aware of every month. And if your investment horizon is shorter, you should be invested conservatively enough that a single month of bad returns won't hurt you that much. Now, if you sell off in October because you fear a drop, you may miss out on the big gains later. December is typically a good month for the stock markets, with positive returns 2/3 of the time since 1928. On average, the market in December goes up 1.4%. If you exit the market in October and you don't jump back in, you'll miss out. Now, Remember, besides the October effect, we have something known as the January effect. Because what you tend to do is through December, you see the markets climb. A good deal of investors, short-term investors, sell and close the market before the Christmas holidays. One or two reasons. They're either looking to book the profit in this year, so therefore they have to sell and be out in the market. They're adjusting for tax returns, or because lots of people are on vacation through Christmas and New Year's, a lot of short-term traders don't want to be in the market over that period of time because they're going on holiday. They don't want to watch and worry about what's happening in the market. So if you get out in October because you're fearing something, well, when should you get back in? I mean, if I was trading some of the indices, I would have been selling out now because I figured they're topped out close to their top. And I would wait for them to fall before I got back in. I would have been very glad to take a profit at 23,000. Now, if indeed the market goes down in October, take time to examine whether the results of bad company fundamentals or simply the psychology of investors. If there's a sell-off simply because people fear October, then it may be possible to find some solid stocks at a good value. Investors' emotions can turn negative when the calendar changes from summer to fall. And this influences stock market performance. In the fall months after summer vacations are basically over and the sun sets early, investors' moods lean towards gloomy. As a result, negative economic and market developments in these months can cause overreaction. And this is according to a report written by MSNBC. If investors were contemplating selling stocks before, a negative development can make the decision easier and motivate investors to dump shares. Now, typically, what we see, though, is slightly different than this. What we actually do see is by the first week of September, vacations are over, the kids are back in school, and investors are looking, especially hedge funds, portfolio managers, pension, are looking to book profit. And the September, October, November season is when they're looking to get that profit on their books. So that at the end of the year, they can say, yes, we had a good year. We did 10.4% or we did 14.8%. Because if they're still trading or those assets are still open, they can't really say that. So they're looking to book all the profits as possible. So statistically, you'll find that September might be a down month, the beginning of October and up month, but you'll see that volume is high and activity is very high. Several noted economists and distinguished investors are warning of a stock market crash coming. Okay. Dr. Farber, better known as Dr. Doom himself, recently told CNBC that investors are on the Titanic and stocks are about to endure a gut-wrenching drop that would rival the greatest crash in the stock market history. Now, that's a little worrisome. But I'm a little worried also with the U.S. stocks trading at all-time highs when there really shouldn't be. Earnings have not been that good. Okay. Retail sales have been all right, but we see a lot of big retailers in very bad financial shape. We see Toys R Us, that's been around since I was a baby, going into bankruptcy, thinking about selling off the European division, closing down the U.S. You know, we see all these four-wall retail spaces going broke. That's going to mean that's going to have an effect on the malls. The malls will have an effect on who they hire over for the summer, the Christmas holidays, and then that'll have a turn on the value of land and retail space. So it leaves open a lot of problems. In the UK, we've seen a lot of worrisome stuff coming out of the Brexit, with maybe the negotiations falling apart recently. So there's a lot of things to be worried about. Now, an analyst named Smithers, who's quite well known, backs up his prediction using a ratio which proves that the only time in history stocks were this risky was in 1929 and 1999. And we all know what happened next. Stocks fell by 89% and 50% respectively. Even the Royal Bank of Scotland says the markets are flashing stress alerts akin to the 2008 crisis. They told their clients to sell everything because it's a crowded hall and the exit doors are small. They're expecting, Royal Bank of Scotland is expecting, as RBS, are expecting blue chips like Apple, Microsoft, and IBM will plunge. Most alarming of all is that Davidson says will cause a collapse. It has nothing to do with the China meltdown, with Wall Street speculation, or even the presidential election. Instead, it is linked back to a little-known economic curse that our founding fathers warned about elected officials. A curse that it was recently triggered. October 19th, tomorrow, will mark the 30th anniversary of Wall Street's crash in 1987, where the Dow Industrials fell some 22% in a single day, which would be a 4,900-point drop if that happened today. In fact, stocks crashed in October 1907, 1929, and 2008 as well. So will this October be another one for that record books? Okay, we have 2 weeks left. Will we make it or not? Now, what they're worried about, all of these different analysts, is the markets are just too expensive. Stocks are too high. U.S. stock valuations are currently very high by most standards. In his most recent weekly column, John Huesman of the Huesman Fund advanced the argument that what investors presently take as a comfortable environment of pleasant market returns and mild volatility is actually quietly the single most overvalued point in the history of the U.S. stock market. In other words, the Dow and other market indices aren't the only thing that's at historically high level. Stocks are historically overpriced. Bonds are expensive too. Bond markets are also trading at lofty levels. With many countries' benchmark interest rate close to zero or even negative, the Federal Reserve makes news when it talks about raising U.S. rates a lousy 1/4 percentage point. We haven't seen the federal funds rate above 6% since 2008, while it hasn't been at 10% since 1989. Are things really different this time, or have we reached the end of the so-called debt supercycle? Debt is likewise at a historically high level. Personal, corporate, and government debt levels are all at the breaking point. Since 2008, when interest rates started plummeting, QA was pushed out there. No matter which government you were, dealing with, whether it's the EU still buying up bonds like crazy, whether it's Japan going into negative interest rates and dumping money into markets, corporations and people who had access to get this debt at very low interest rates got heavily indebted. And corporate debt is very, very high. Government debt is very high, and balance sheets are upside down for most central banks. We should expect a recession to eventually hit an economy that's been expanding for 8 years. But the resources that we need to deal with any contraction are extremely limited. And that's the problem. The U.S., even though they started raising rates, are still very close to zero. And their balance sheets are extremely high. The EU has run out of any kind of ammunition to help any wrinkle of the market. The Bank of England can't offer any assistance. The Bank of Japan is buried in debt. They can't go. They're in negative interest rate. They can't do anything. So if there's any kink in the market, there's nothing that most central banks can do. Now, Puerto Ricans are living through this right now. First, they had a partial default on government obligations, and now the hurricanes have devastated their island and its economy. When borrowers can't repay the debts, a new financial order must evolve because the banks are upside down. Their debtors can't pay them. The island can't borrow money. The businesses can't borrow money because they're also upside down. And now they need to recover. And how does this happen? Now, we also can look very closely, and we see unfunded public and private pensions are probably a hydrogen bomb sitting at the U.S. economy's center. It's abundantly clear that pensions are grossly underfunded. But while many people are debating ways to correct this problem, very little is actually getting done. And if the markets crash, these pension funds will be in bad shape because the value of their assets will drop tremendously, and they'll have to scramble to bring them up to not acceptable, legal limits. Unfortunately, the problem will get much worse if equity markets see a significant correction. Any loss of principal will drastically affect pension solvency, and the math will quickly become untenable. The devastation would be immense. Personal, corporate, and government budgets would get busted, and the whole system would need a reset. Of course, the North Korean crisis certainly hasn't caused markets to panic, and if the threat of nuclear war doesn't scare investors, nothing will right now. Investors are very happy. When investors are making money in the markets, they tend not to worry about other things except what might affect the markets. Perhaps, but I believe financial market weakness will soon be on full display this October, which will cause uncertainty. That can lead to doubt, which could lead, in turn, to fear, which sometimes results in one of the great panics that we've seen in October's gone by. So, again, is this 23,000 a sustainable point, or are we going to see investors run and send the market? Because all it takes is, if these big investors start selling off, booking their profits, the markets start tumbling down, all the little speculators are going to be running along with them. Consider the fact that Fitch Ratings recently downgraded the debt of Deutsche Bank to BBB+. This major European bank continues to struggle, but it's not the only one that's in trouble. Several Spanish and Italian banks are barely above water. These are all cracks in the globally connected financial system. Now, we were able to bandage these all through the last few global crises, but because the wounds haven't healed yet, the stitches are still fresh, we don't know what could happen if the global markets went into a panic, because, again, we have nobody to help them. China, the world's #2 economy, is also showing signs of stress. Shadow banking accounts for 80% of the financing needed to support Beijing's GDP. But tales of fraud and abuse continue to plague Chinese investors. Look what China did over the last 2 weeks on cryptocurrency and Bitcoin. They were one of the freewheeling economies allowing it all to happen, and they instantly, for some reason, closed down the exchanges. Not illegal exchanges, they closed down the approved legal exchanges and outlawed ICOs. Here at home, U.S. student loan and credit card delinquencies are on the rise. The system has absorbed the loss so far, but the future remains uncertain. And nobody's talking about automobile loans and how many people are upside down and owing more on their automobiles anywhere near their worth. Nobody's even talking about Volkswagen sitting with billions of cars that have nowhere to go. All this, makes a dent. How it's put on Volkswagen's balance sheet, how they recover of this mess. We're looking at the Wells Fargo scandals in the U.S. The tiniest snowflake can cause an avalanche in an unstable system. But fortunately, there's still time to prepare. Now, I recommend seeking out asset haven assets such as gold and silver. Resist the hype to do otherwise. Now, as J.P. Morgan once famously said, gold is money. Everything else is just credit. My advice, hold some real money and watch history unfold. Nobody can explain to me why Bitcoin is trading at $5,800. There's no rhyme or reason that it's gone up almost 7,000% in a month. Where is this coming from? Okay. It's all this psychological mess out there and the psychological traders. Everybody thinks they're going to get rich overnight. And one wrinkle, we're going to be in bad shape. Many of you know that I've been bullish for quite some time. Years even. I felt fine being optimistic when almost everything else was sounding alarms. I was telling everybody in the 2008 crash, when everything went down, start buying, buy and put it away. These big corporations weren't going away. Buy and put it away. Buy on lows. Whenever you see a low, buy, because it will recover. But now so much of the street has joined me in this optimistic camp. I'm starting to feel like I'm doing something wrong. What am I missing? I'm not optimistic at all. Listen, I'm optimistic about the U.S. economy, the European economy. I'm not optimistic about any individual stocks. I'm not optimistic on any indices. I'm saying they're way too high, and I believe they're way overvalued, and we're headed for something. I can't explain the value of the US dollar. I can understand the euro, can't understand the Japanese yen. So what am I missing? Man, did I miss out on buying these stocks back when they were cheap? Now, I didn't buy banks. I was worried about banks. Now, I was in Bank of America, which I held on through all of this mess, but I'm not even back to being even to where I got into Bank of America. But fortunately, because prudent investors do stay diversified, I stayed long Citigroup, and based on valuation, the international exposure, I also remain long on KeyCorp because I think the firm could be a winner among regional banks down the road. Okay. Lately, I'm looking to add Bank of America or add more Bank of Americas. They started issuing dividends again, and they were one of the best dividend stocks in the U.S. for many years. Now, consumer sector. Now, this is a very weird sector. I think we're going to see lots and lots more bankruptcies, especially in retails. We're going to see retail stores closing down. We'll see big chains pulling in their brick and mortar stores as the internet takes over. So we're going to have a very, very strange Christmas selling season. So we might have a very good Christmas selling season, but who's going to be the benefits of this? I think we'll see Amazon and eBay. We'll see Walmart online do well. But what will happen to Targets? What will happen to Toys R Us? Because how many people are actually really going to go stand online when they can buy online instantly in the middle of the night? And around the world, no matter where you are, delivery services are getting much more efficient. And you can buy online and have your package at your door virtually free in 2 or 3 days. So consumer sector, I'm very, very worried about. Okay. Then we have defense. Now, North Korea threatens against human civilization isn't going away anytime soon. Terror in the Middle East isn't going away anytime soon. So we're going to probably see a lot more spending for military. So it might be a good way to look. Lockheed Martin, Raytheon, any of the big military providers could be a good investment through October and November. So if the markets come tumbling down at any time, these might be good buys. Now, I've thought about adding Boeing, General Dynamics, Northrop. Okay, but we have to stay diversified, and we have to understand where they're buying and what price they're selling for. Now, energy is also another sector. U.S. energy markets got hit really bad with the drop in oil prices, but they rebounded very, very quickly with shale producers finding ways to produce oil cheaper and increasing technology. They've all come back on board, and the U.S. is pumping out more oil than ever before at cheaper prices and able to fight these low prices. So I'm kind of positive over on energy producers. Now, we also have to take a look at what the hurricane has done to the U.S. and to the U.S. markets. The markets have yet to actually respond to the devastation in Florida and Texas. This had a very adverse effect on the jobs report this month, where the U.S. has the first negative jobs report that I can remember in a very, very long time. Not that it was weaker than expected. We had minus job growth. So I hate to say that when many people are still suffering the effects of Harvey and Irma, but it's obvious that certain firms will do well in the rebuilding that's following these storms. Okay, there's going to be tons of money, but you have to find out who's going to be spending the money if you're looking for individual stocks to rebuild Puerto Rico, to rebuild Florida, to rebuild Texas. So automatically, Home Depot, biggest DIY providers in the U.S., whenever homes and businesses are damaged, yes, even large contractors get jobs, but lots of little contractors running to Home Depot and buying all their supplies to fix their little jobs. So Home Depot should do extremely well during this. And then manufacturers that manufacture things that would supply for hurricanes. So keep an eye on these. And then we go back to retail again. So as noted, Home Depot is already on my books. Regular readers also know that I'm long Walmart. I firmly believe Walmart was one of the most successful conversions from brick and mortar, and they still have God knows how many brick and mortar, to online sales. At the same time, they've expanded their grocery offerings. So they have a very positive outlook for October, November, December. So they might be a buy if the markets dip down. Whenever you can buy them on a dip, keep an eye on them. So we'll take advantage of this October effect if we can. Then technology. Technology is a different animal. You know, we all have to be diversified. I have very little of my investment in technology because I don't understand. I understand some technology, but there's so many little companies, so many big companies that I get lost in them all. And the only one that I'm really worried about is Tesla. You know, it's all dependent on one man's promises, and he delivers most of the time. But I just don't know if they can continue living up, and they drove up their market so high. His delivery has been low on the new cars. Sales have been very good, but you know, we're not sure where it's going to go. Okay. Oracle has had a good run, and where you should be looking at transports. The airline industry. Whew. Airline industry worries me a great deal because I don't like the treatment and the bad press that the airlines are getting. I don't like their shift to this cheap budgets. I think a lot of people are just going to stop traveling eventually. You know, not businessmen will still travel. They'll travel less. People going on vacation may travel less. I mean, I'm worried these days getting on a plane, not for security. I'm worried about the treatment you get. Okay. Then we go to transports under carriers, deliverers. FedEx and UPS are both soaring. I mean, they're both out. You know, as long as oil prices remain down, which we don't see them going up in any near future, and online sales keep increasing, FedEx and UPS will keep on soaring. So there'll be good buys, especially before the holiday season, if you can buy them low. And then, but we have to keep an eye on Amazon because they're testing and about to introduce their own delivery service. If Amazon can find a way to do their own delivery service, this is going to have, or if Amazon moves forward with drones and those kind of deliveries, because most of these, the benefit for FedEx and UPS on the online sales is the biggest one is Amazon, and if Amazon can shift their business or shift their logistics elsewhere, keep an eye close. But that's where we look at for the balance of October and what might happen if we have this October effect, what the odds are of having an October effect, what the analysts are looking at. So keep an eye, be interested. You know, if you're a stock trader, learn some more. If you're just a guy like me who puts some stuff in his portfolio, because I'm a long-term trader, I'm not a short-term investor when it comes to stocks. So thank you very much. Have a great day. And again, go to www.tradetime.com and give them a shot. You'll find it's a very interesting trading scenario. It's a very interesting system, and it's a very effective and efficient platform. So thank you very much. Have a great week, and thank you for supporting investing.com. Bye now.